Hello, aspirants, and welcome. A crisis in West Asia can seem distant, but its economic shockwaves hit India hard. Today, we're going to break down this exact scenario, a classic case study for your GS Paper 3 on the Indian economy. This is exactly the kind of dynamic issue you need to understand. So, here's our plan. We'll start with the initial price shock itself. Then, we'll trace how that shock ripples through different sectors. We'll look at the big macroeconomic pressures it creates, see how the government tries to respond, and finally, wrap it all up with some key analysis for your mains and interview prep. This problem impact solution framework, it's perfect for structuring your answers. Right? So let's dive in. The first and most direct hit to the Indian economy from a crisis like this comes from one thing: a sharp, sudden jump in the price of crude oil. This is ground zero for the entire event.
Now, you might hear about Brent crude in the news, but for India, what really matters is something called the Indian crude basket. Think of it as the actual average price we pay for the mix of oil we import. This is the number that dictates our country's massive import bill.
And look at how severe this shock was. The price for our basket shot up to a staggering $157 a barrel on March 23rd. What's really telling is that this was almost 19% higher than the global average price at the time. It just goes to show how particularly vulnerable India is.
Exactly. Now, there was a bit of relief after a ceasefire, and the price did drop to around $120. But let's be absolutely clear, that is still an incredibly high price. It just highlights the constant volatility and the persistent risk this whole situation poses to our economic stability.
So, that's the primary shock. But it never stops there, does it? A higher oil price isn't just about paying more for petrol. The impact cascades through the entire economy. Let's call it the ripple effect, and it's crucial to understand how this works. And this slide is a fantastic summary for your mains answers. Think of it as a chain reaction. Suddenly, energy-intensive industries face supply disruptions. Our farmers are staring at a fertilizer shortage right before the Kharif season. Transportation costs go up, which means everything becomes more expensive, and it even hurts our exports. It's a complex web of interconnected problems.
All of these individual ripples then combine to create these huge macroeconomic waves. This is where it becomes a real headache for the country's policymakers, threatening our overall financial stability.
And to put a concrete number on that vulnerability, just look at this. A massive 16.4% of India's merchandise exports go to West Asia. So any disruption there is a direct hit to our export earnings, and that in turn puts pressure on our current account deficit. This creates a classic tug-of-war for the Indian rupee. On one side, the huge bill for importing oil and fertilizers is constantly trying to pull the rupee's value down. But thankfully, on the other side, we've had a strong cushion from foreign investments, like the $13.6 billion that flowed in during March, which has really helped prevent a much sharper fall. So if you were to boil all this down for an exam answer, it really comes to two major macroeconomic threats. Remember these terms. First, a widening current account deficit, or CAD, and second, rising cost-push inflation. These are the twin challenges.
Okay, so we've laid out the problem in detail. Now, let's shift gears and look at the response. Faced with this crisis, what can the government actually do? Let's focus on the fiscal measures they've taken to soften the blow.
This data from the CBIC chairman really tells the story of the government's tough balancing act. To give us some relief, they cut excise duties on petrol and diesel, but that cost them 7,000 crore rupees every 2 weeks. They try to make some of that back by taxing fuel exports, but that only brings in about 1,500 crore rupees. So you're still left with a net revenue loss of 5,500 crore rupees every fortnight. Annually, that's a potential hit of over 1.3 lakh crore rupees.
And that's not even the whole picture. Beyond these tax cuts, there's immense pressure on the government to provide more subsidies, to the oil marketing companies to keep petrol prices in check, and for fertilizers whose prices are also skyrocketing. All of this puts our fiscal deficit targets under serious strain. All right, let's pull all of this together. For all of you aspirants watching, this is the part you really want to focus on. What are the key takeaways for your exams? This quote right here is absolute gold from the RBI's own report. I would suggest you commit this to memory. It gives your answer so much weight and credibility. For every $7 increase in oil prices, GDP growth can fall by about 15 basis points, while inflation goes up by 30 basis points. That's the trade-off. So let's just apply that to the current situation. The RBI's baseline was much lower.
With prices now about $50 higher than that baseline, a simple calculation tells us that if this persists for a whole year, we could be looking at a potential 1% drop in our GDP growth and a 2% rise in inflation. That is a massive, massive impact.
And this brings us to the quintessential policy challenge, the kind of question you might face in your interview. As a future policymaker, what would you do? How do you possibly balance these conflicting goals, taming inflation but also keeping economic growth going, all while making sure the government's finances don't fall apart? There are no easy answers here. We hope this analysis helps you frame your thoughts. All the best.